Let's turn to the macro conversation, into the Fed discussion for some answers. Cullen Roche joins us from Disciplined Funds, the CIO. Cullen, great to have you here this afternoon. It's been a wild couple weeks. Take me through the way you've been thinking about it.
Hey, Oliver. Yeah, I mean, I liked your description earlier about how, this isn't necessarily being caused by things like the unwind of the carry trade and, volatility or whatnot. But really, I think a big part of this is that the narrative has been wrong. That I think a lot of people have been thinking of the Fed's policy maneuvers in terms of this so-called soft landing. And that analogy has just never really made sense to me because what the Fed really did was the Fed raised rates to slow the economy, to bring inflation back down to something normal. Okay, so the economy isn't something that lands. It doesn't land like a plane and then stop and then everybody just gets off. The plane's always flying. And so what they did was they slowed the plane. They avoided some turbulence. It's worked so far. But what they really need to do, and the way this ends, is their determinant of success basically is, can they get the plane back to cruising altitude? So they need to still normalize interest rates, get interest rates probably back down to something in the 2.5–3% range where credit markets can normalize, the housing market can normalize, people can borrow, to purchase homes and automobiles and things like that. So the story there is that people got a little bit ahead of themselves, I think. This story is far from over, and the Fed has not achieved anything remotely close to success quite yet.
I really like your point about the landing. It doesn't work, right? It's such a sort of approximating a way to think about it, and it's just not the best one, right? Because the economy doesn't stop; it keeps going. So you can't make the analogy. I mean, I guess they could crash, but it can get back on its feet. Where it seems like we did have a major slowdown after COVID, and then we had a surprising amount of strength, and we kind of had some reflationary scares along the way. And so now we just kind of tilt to the other side, right, where it's more kind of the recessionary scare. But there's also kind of a closing window here if you believe some of the late cycle indicators, the SOM, the uninversion. I mean, this time it's got to happen within like 3 or 4 months, or else those things didn't work.
Yeah, I mean, I think last time I was on, I kind of talked about how this next sort of 6 to 9 months is really like the sort of crucial period where we realize whether, the Fed's now flying the plane at still a pretty slow trajectory here. So, the kicker is, can they pick up the velocity and get us back to cruising altitude? Or, is the plane kind of stalling here, and to the point where they're forced to do something like an emergency thrust where they have to blast the engines and then try to bring us back to cruising altitude because they basically stalled the plane. And that's the risk we're going to find out whether or not, how far. It's starting to look like they're definitely behind the curve now. The question in the next 6 to 9 months is, how far behind the curve are they really?
Yeah. Where do you think, Cullen? I mean, could this get really hairy? Will the Fed have to try and go pivot hyper dovish, or do you think Powell's going to keep us cool?
Yeah, I mean, nobody knows. I mean, I always like to say, predicting the next 6 to 9 months of the markets is, a guess. But at the same time, I mean, we know from past history, the Fed has a pretty established history of being late to the party, behind the curve. And so there's a lot of risk on the table in the next 6 to 9 months. And all the trends are sort of moving in the wrong direction. The most worrisome part about all of this is that even if they started cutting in September, they're still at 5%. I mean, mortgage rates are still going to be unaffordable for the vast majority of Americans for the foreseeable future. I mean, we could get well into 2025 before the Fed gets into a really sort of so-called loose policy stance. So, yeah, they're behind the curve. There is, I don't think there's a need for emergency cuts or intermeeting cuts at this point. I mean, you do have 7 weeks now between now and the September meeting, so that's not great. But at the same time, I think if they cut in September, they cut in November, and then they cut in December, they can at least start to really, create an established trend of where the policy rate is going. And markets will front run this. I mean, we've already seen this to some degree in the bond market. Markets will front run all this, so mortgage rates will start to, sort of front run the Fed and whatnot. But they've got to be on their toes about this in the next 6 months for sure.
Okay. So when you look at the range of possibilities, Cullen, does it bring up potential multi-step moves instead of like 25 bips, 50. I mean, does this become a really kind of like poker read of the guy across the table with Powell instead of like pure data at this point? Because ultimately, I mean, yeah, things have softened up, right? We're like hitting these late cycle indicators, unemployment, et cetera, but they're still above their target. And nominally, the figures are not awful, right? And we actually just had a good GDP print. So, like, this kind of gets into a little bit of, like, it seems personal game theory in a way.
Yeah, exactly. I mean, that's the thing is that a lot of people, I think, in the last sort of week or so have overreacted to a larger degree. I mean, the jobs number last week, it was not good. It's not a good trend. But at the same time, I mean, you've still got wages that are growing, 3.5% to 4% across the board. That's relatively high. The 91,000 jobs, that's not good, but it's also not the end of the world. So the part where this gets really hairy is if you start to see things like let's say next month or the following month, you get a negative print or you get revisions down to low single digit prints or something like that. Then you start getting into a situation where the unemployment rate is rising to 4.5% to 5%. And then the Fed is definitely very far behind the curve. And that's the point where you're going to see the likelihood of 50 bip, cuts from the Fed. And the probability of that is rising. So that's the thing that the market is now starting to price in. It's not an emergency yet, but the probability of a bad outcome is definitely rising. So I think caution is warranted for people, especially for people that have short time horizons here.
Okay. And how does it change the thesis, the trade? I mean, not quite as obvious to just park in the T-bills and chill with rates coming down, but is that generally kind of the theme to be wary of higher risk products at this juncture?
Yeah, I mean, if you've got short time horizons, it really depends. It depends on your time horizon here, I think. I think if you've got a long time horizon, events like this are a godsend because you can just continue to dollar cost average or pour money in a discretionary manner, think long term, ignore all the short term noise. If you've got a short time horizon, 0 to 5 years or even up to 10 years potentially, this is much trickier because the stock market poses a much bigger risk inside of those time horizons for you. So in terms of the T-bill and chill trade, I think that people should probably be starting to think outside of the T-bill and chill. Sure, you can still lock in 1-year T-bills at a decent rate here, but I think that given where the Fed is likely to be in 6 to 12 months, rates are very likely to be much lower, especially if something problematic hits. That means you should be extending durations. You should be going into 2, 3, 5-year notes. Who knows how far out your risk tolerance can afford, but you should definitely be thinking about extending maturities in terms of the Treasury bill trade and starting to get a little bit longer in the anticipation that the Fed is not likely to be at anywhere close to 5.25 a year from now.
All right. Great stuff, Cullen. A good time to catch up. Thanks for the thoughts and a little
Thanks, Oliver.
advice there. Appreciate it. Cullen Roche, CIO at Disciplined Funds.